Thank you very much, Heather and Cornelia. And again, thank you very much, everybody, for joining us this morning. I would now like to introduce Fagmeedah, Petersen-Cook, and Janina, our esteemed guest, for joining Patrice and myself to talk about how the industry is approaching the impact of COVID-19 on retirement funds. So maybe I can start first with a question. Maybe I can ask Fagmeedah this question. Fagmeedah, how has COVID-19 changed funds approach to investment strategy? Has it made any difference?
Good morning, Rudigor. Yes, I think pension funds and other institutional investors have taken quite a considered approach to how they need to review their investment strategies and actually set their investment strategies going forward. What I've seen a number of institutional investors do is quite a rapid adoption of modeling to really test the veracity of their thinking. So, establish scenarios for how the pandemic is likely to play out, for what the economy is likely to look at. Scenarios V-shaped, U-shaped, W-shaped, or I said this morning, a Nike tick, and test the decisions or the changes that you want to make in your strategy against each of those scenarios. And I think leading to a lot of decision making on the part of institutional investors generally. So they're needing to make big decisions, possibly significant changes, but doing it in a very considered and measured way.
And maybe I just want to stick to something that you said. Now, do you think those decisions are going to be made quite quickly? Are they looking to make decisions quite rapidly, or is it a slow and measured approach? Because I can hear what you're saying about scenarios and testing all of that, but how do you see the decision making actually taking place?
Yeah, so I think given that it's quite significant decisions, that's why they're taking a measured process or taking a measured approach to making the decisions. But certainly I'm starting to see changes come through in portfolios already. So, switches from value managers to growth managers, very, very sort of real processes in terms of looking at alternative asset classes. So you're seeing an accelerating institutional investor decision-making process, implementation thereof. So I think we have this sort of lag of doing things from committee cycle or meeting cycle, but they're trying to contract implementation time frame. They've made decisions.
Okay, thank you. I think that's very insightful, Fagmeedah. Janina, maybe I can ask you another question that I've been thinking about, and that is that so we're currently living in a very low return environment from a JSE perspective. JSE is quite suppressed. Interest rates are very low. How do you see clients adjusting their portfolio return targets? Because there's a reality that they're looking to match assets to liabilities. Are clients taking that into account, and how are they taking that into account?
Very much so. I agree with you. The whole terminology is low return environment. We've had an expectation for a low return environment for various reasons for many years. They're just on the same growth drivers as we've seen in previous cycles. And then we hit COVID-19. So now we're in a dramatically different environment. We do feel that there's a lot of offshore assets that have definitely in bubble territory to the extent they've gone up with no real formal underpins. We know obviously locally, SA Inc. shares are really in the doldrums. When are they going to turn around? When are they going to give good returns? So it is very difficult to see good growth drivers. And I guess one of the main measures is, yes, we do see return targets portfolios having to be mitigated downwards. But I think there's a lot about communication to members about return expectations in the future. There are days when you could easily earn CPI plus 6 or 7% over various cycles, and members could plan for retirement on that basis. We think it's going to be much tougher going forward, and people really need to temper expectations.
Yeah, and then Patrice, maybe in your seat, how do you think an asset manager is responding to this protracted cycle, and in terms of fund
Yes,
design, should be in there?
very interesting. The headline to Business Day this morning was that a lot of investors have missed the current rally of the JSE, which has been up from the bottom 50% by being in cash. So cash has been the right place to be for the last 5 years, maybe even longer, from on 10 years on a risk-adjusted basis. But I think there's a few things which are fundamentally different going forward. One, Rudigor, return on cash is likely to be low, and the yield curve, which was very flat for 5 years, suddenly has become a lot steeper. So this means that in portfolios, the use of credit and bond funds are likely to yield much more attractive returns. And we actually think that the sweet spot is in between the two extremes of cash and equities, probably in the bond longer end side of the bond area, adding some credit, given the steepness of the yield curve, and on a risk-adjusted basis, given that we don't know where the South African economy is going. That's where we feel that that's likely to be the right place to be. So I think in general, I think bonds look attractive. I think credit funds look attractive. And in terms of return expectation on a real basis globally, our bonds are probably the most attractive we've seen for a long while.
Okay, I think there's two things that you mentioned that I want to maybe switch to Janina and then to Fagmeedah in terms of asking a question. So, Janina, how do you see pension funds adjusting their portfolio asset allocation? So, do you see them making changes in terms of how they were positioned maybe, say, 5 years ago versus now, and maybe for the next 5 years?
Very much so, and very much aligned to what Patrice has said in terms of risk-return objectives across a spectrum and relative attractiveness of the South African bonds. So what we are seeing in terms of particularly strategic asset allocation modelling, as I said, for some time we've been talking about a low return environment, and a lot of that is driven by lower expected returns on equities. But unfortunately, equities don't have a lower volatility just because they've got a low return expectation. So a lot of our asset allocations have been moving towards more bond-like portfolios, but obviously looking for alternative asset classes that can still add alpha. So for example, don't just give a normal vanilla bond mandate, give a flexible bond mandate, so that the manager's got the opportunity to look at other asset classes, including property, etc. And then also in the traditional alternative space, the hedge funds in particular, obviously giving you good protection in times like these, maybe not running as hard when equity markets are going up, but still giving uncorrelated alpha, and then also in the unlisted space. So definitely looking those funds that can to invest into long-dated investments and obviously get a liquidity premium. So again, it's a different way of adding alpha, reducing some volatility. We've had a lot of focus from clients looking at, as members transition towards retirement, as well as after retirement, if they're in living annuities, they need lower volatility, but they still need good real returns. It is a lot of review of what other asset classes across a full spectrum can be accessed, and not just a traditional sort of equity versus bonds.
Yeah, so I hear what you're saying in terms of some, depending on where you are in the life cycle, needing lower volatility. But I think a big part of what you and Patrice both said is about risk. So Fagmeedah, maybe I want to ask you, are you seeing that in the current environment that people are moving up the risk curve and that they might feel that they're taking on more risk, or that they're being pushed to take on more risk? And also, is it real? Are they really taking more risk if that's the case, or is it more a perception rather than reality?
Yeah, Rudigor. So, I mean, I think the constrained return environment, which existed before the arrival of this pandemic and the sudden economic crisis, has pushed funds to move up the risk curve sort of before the pandemic started already. So, as an example, funds that might just have been doing sort of regular LDI on pensioner liabilities. You will have seen in the last few years a significant move to them repoing part of that portfolio so that they can do a portable credit alpha overlay onto their portfolio. So just by nature of that, taking on a lot more credit risk, and some of that, some of the portable alpha strategies would have been allocated to, significant credit risk, down to double B mandates being given. I think that's being exacerbated now by returns on cash being very poor, just because of the monetary policy stimulus that we're seeing coming into both the domestic economy as well as the global economy, pushing investors further up the risk curve. And then I think investors are starting to perhaps look at risk a bit more, a bit more incisively. So you're starting to hear people raise concerns about tail risk in government bonds, just given the steepening of the yield curve, which Patrice referred to a few minutes ago, and starting to say, well, does, for example, green inflation-linked bond portfolio actually represent a significant increase in risk compared to sort of government inflation-linked bond, and doing that risk trade on a very measured basis again. So, yeah, definitely seeing investors moving up the risk curve. Some of it, I think they are feeling like they're being pushed. I don't think you want to do repos if you don't need to, because you're actually taking on bank risk, obviously, there as well with the credit of the bank that you're repoing to. But then I think the change of view in terms of consideration of risk is also leading to some interesting outcomes. You've also seen some funds consider private equity recently, which they might not have considered before, just because they're confronted with a very low sort of equity return expectation over the next few years, and they need to achieve their real returns, significant real returns, in order to meet their liability promises.
I'm just want to make a few notes here quickly, because you made a lot of fascinating points. I'm really enjoying this, because if I think about the last 8 years, Ashburton's actually had a lot of success LDI-wise. I don't think we've got any mandate that's got LDI plus double B risk per se. But it's interesting to hear that some clients actually probably are forced to move there because the mismatch is probably pushes them towards that. So, so I think firstly that. But in terms of private equity, is that because I just want to get a distinction? Maybe Janina, if you can also jump in here in terms of I think there's a difference between earning an IRR return that you and versus I think Janina, you were talking about debt funds, and that's more of a cash-like return because you're getting a coupon. So I just want to get a distinction. How do investors think about return, that there's a mark-to-market, and that mark-to-market is moving up versus and down potentially in the current environment, versus where a debt fund possibly pays coupons and it's more certain that your outcome is a little bit more certain in terms of that it's contractual, and also higher up in the capital structure. Do investors make that distinction when they consider these alternative asset classes?
I'm happy to speak to the LDI aspects. I mean, we found massive interest in LDI in this environment because obviously, as you'd be aware, real interest rates went up quite dramatically. So in order to buy inflation-linked bonds, it was a good time. And then funds that have had LDI in place, I mean, they actually almost ignored what happened to the market in terms of the crash in March because they were so well protected. It's exactly the strategy that delivered as you wanted to in this type of environment. I think there's a keen understanding of that mark-to-market in this environment. Makes a lot of sense for LDI. And then yes, definitely appetite to add credit into the LDI strategy. I think you always find clients are quite concerned about credit, and particularly in this environment where companies are struggling. But let's face it, your credit risk is still vastly less than equity risk. you're going to invest in the equity of a company and something goes wrong, you get nothing, whereas your credit is still relatively protected to some extent. Definite interest and interesting in terms of current environments that lots of clients have actually implemented or topped up LDI.
I think I need to get your insights into this, because I'm a credit guy and Patrice is an equity guy. But Patrice, maybe if you can respond to that, and also then I think the next part of the discussion is maybe to also say how do we look at active versus passive, and using that when we talk about equities then per se.
Maybe to respond to the latter part, I guess. Firstly, passive is not what it used to be. I mean, the sense of all investors are now, if I look at our own passive offering, I mean, all investors are fairly active in terms of engaging companies, whereby in terms of the governance aspect, we engage companies on various aspects of E and SG. And I think the way the market is evolving is really, rather than active and passive, we're going to a gray area also of, if you start to go into actively manage passive funds, factor investing, I think we have a continuum, which is great for pension funds. It's not just active and passive, but I think the characteristics are quite similar. And now you can start to choose where you are in terms of the degree of one being active. And then the last point on you mentioned private equity. I think the important point is that the level of volatility in listed assets has been so elevated that I think there is a place for unlisted aspects. I think Janina mentioned that, where even private equity, you can focus on the cash flows rather than worry about the volatility that you see in, for instance, equity prices. I think that also makes it more attractive from a risk-adjusted return perspective.
So I just dropped my pen here, but Fagmeedah, would you agree with that? Because you made the point about private equity, and how do you see your fund actually thinking about it?
Yeah, so Rudigor, it exactly ties back to the point Patrice made. So, we've always looked at sort of return on equity as being sort of the reason why we invest in equity. The return of capital, return on capital as being the reason why we invest in equity. What a lot of investors are focused on now is actually just the return of their capital, and you've still got a lot of investors investing in cash for exactly that reason. And as Patrice has said, you've got a steady sort of set of cash flows coming out of your private equity investments as they sort of redeem over time, and I think there's a sense of certainty there, notwithstanding the risk around the actual investments being made. But I think there's also a bigger feeling of control, or being in control of the value of that investment in terms of private equity. So, there's obviously recognition of execution risk and talent risk on the part of the private equity manager, but there's a far greater sense of control over your investment and the valuation of your investment, etc., once you've actually committed to the private equity fund.
Okay, well, that's encouraging. Janina, do you share that view?
Oh yes, very much so. And I think, obviously in terms of a private equity investment, yes, you do have a lot of insight into the investee companies and what's happening in it, and in terms of valuation. Obviously, it's quite challenging in this environment that your private equity valuations don't move at the same pace as your listed valuations, and there's somewhat of a lag. So obviously, some amendments were made as at 31 March and have subsequently been made at 30 June. But it's a much more measured pace. You don't get that dramatic change in value, which then comes back with the sentiment changing. So I think it makes a lot of sense. We do hope that a lot more funds will be able to focus on investing in unlisted investments, because it's definitely an area where you can make a lot of impact in terms of the underlying investment.
Yeah, I think I agree with the measured part. I agree with everything what you say, but I just want to talk about the measured statement, because to my mind, I think a private equity manager doesn't really have upside to mark up his book versus because it's rather just happy to keep it at cost, except when they get close to realization to list the company or to sell the company. There isn't really a reason to mark it up. And because I want to bring it back to the topic of what we're talking about now in terms of COVID, are some of the unlisted assets maybe marked incorrectly, or they just marked conservatively, and because they were never marked up, similar to how a listed instrument could have moved up, because you also use the terminology bubble, and I'm not saying that anything in South Africa is listed-wise is in a bubble, but in terms of that, just that mark to market on that quarterly basis, it feels to me that they probably weren't marked up that much, and I think quite a lot of investors are expecting that they should now be marked down dramatically, but maybe there isn't that much reason for it yet.
Well, certainly it was an interesting quarter, March to June, because as I said, in fact, there were some markdowns at 31 March, just recognizing impacts that were already being felt, but not necessarily a lot. You then had the down in the listed market and recovery. So in fact, we haven't seen much difference in private equity valuations. And I agree with you in terms of a conservative approach, but I think that is what you want as an investor into private equity. You do know that by the time you finish your 10 to 12-year term, you will get the full markup. So why do you need a quarterly markup? Why do you want less conservatism from quarter to quarter when you are a long-term investor and you know that in the end you'll get the correct value because it will be fully realized on payout?
Yeah, no, I fully share that. I'm just watching the time, and there's two main topics that I still want to discuss, and that is that are you seeing, again, maybe I'm stick to Janina, but I actually want to get Patrice's view on this as well. Are you seeing that clients are switching out of South African equities more into offshore equities, and the inverse, that they are switching more to local fixed income and less to offshore fixed income?
We're seeing a difference now during COVID-19. That's been a long-term trend. So essentially, we've had better returns on South African bonds than peers, and versus perceived risk in terms of those bonds, and obviously potentially higher bond coupons going forward, and not necessarily yet increased sovereign risk, although there has been a change there. But a very negative view on South African Inc. shares. So definitely looking for value in terms of rand hedges locally, but then definitely equities offshore. So I think that's almost been a traditional that clients that took money offshore have tried to keep the offshore mainly in equity and assets locally, therefore having to seek other asset classes, because otherwise they're pushing up against their 75% maximum equity. So definitely looking for bonds, flexible bond type mandates, including some property, and then moving into the alternative space. Obviously, in this environment, most clients well up against their limits in terms of how much they can have offshore because of the rand depreciation. So if anything, having to bring money back within a 12-month, obviously, correction period and having to decide where to put it. So you will definitely see some going into bonds. And then we all want to know when we think the market's going to turn in terms of SA Inc. And it's certainly the last few months, the lockdown, the very slow lifting of the lockdown suggests that return on value in terms of local stocks or locally driven stocks is still quite some way off.
Patrice, do you agree with that?
Yeah, if I can just reinforce what Janina said, the big return driver for offshore assets has been the depreciation of the rand over the last decade. It's like 8% per annum. And obviously, we think the rand is really in terms of 2 standard deviations from PPP. So, and as Janina said, most of the managers are at their max limit. So it's not as if that institutional money's got room to go offshore. On the other hand, South African bonds are looking a lot more attractive on a real return basis. I mean, offshore, you asked about offshore bonds. I mean, that's you're paying to have your money in safe assets offshore, so there's no return there. Whereas here on a real return basis, I think it's still very attractive. So taking out the pace of depreciation that we've seen over the last 10 years and the fact that most local managers are max offshore, I think if you look at the alternative of that we have here, I think from an expected return viewpoint, I still think local bonds are quite attractive, and I would agree with Janina there.
Okay. I think I want to get back to the main topic, and that is COVID-19. Fagmeedah, so if I think impact is, as Heather and Cornelia discussed, is hugely important. It's becoming more and more important globally, ESG and specifically impact. How do you see in the current time frame? How do you see a pension fund making a difference to its employees, the country, etc.? How do you see that? What are the things that they can do to make a difference, and should they?
Yeah, Rudigor, that's really been a vexing that I think pension funds have had to deal with in the last few months. We've seen some sort of recovery funds or distressed funds being launched by some of the asset managers as an offering for funds who want to actually, allocate some of their assets to these vehicles, and the intention obviously is for these vehicles to help out companies which are facing significant funding challenges, typically through debt instruments, and really help those companies with their recovery or just see their way through COVID-19. I think the challenge for a lot of pension funds has been not having a good handle on the risk that those investments currently represent. And, going back to the scenarios that I spoke about at the start, the prospects of returns on those funds in, say, an L-shaped recovery or even the Nike tick that we spoke about earlier is fairly uncertain. And so funds have been, I think, not as forthcoming in terms of allocations to those types of assets as they could be. Hopefully, as we have greater certainty of how the economy is going to emerge out of this pandemic, you'll see sort of more allocations to those types of investments. Of course, that's the most dramatic in terms of impact investing that a fund could consider at the moment. I think as funds are considering sort of unlisted investment options, they are looking at other types of impact investing, such as the green bonds, for example, which I think are growing in popularity, just because of the pressing need we have in the South African economy for alternative suppliers of energy. And you're also seeing things like social infrastructure funds, job creation funds being considered as part of the universe of alternates. So there's been quite a significant overlap, I think, in terms of offerings in South Africa, in terms of private equity and private equity investments almost being naturally impact investing. I mean, typically private equity investments are growth assets, right? You don't typically buy into private equity funds that are targeting value investments, other than, of course, in the distressed type of scenario that I've spoken about now. And so typically your growth investments in your private equity funds will be doing job creation as a secondary outcome in any event. And as I said, you've got your infrastructure, your green bonds, job creation, etc.
So we've also been thinking very deeply about what is the role that Ashburton can play in this, because obviously we've been managing a job creative fund for the last 6 years now already, and we've done a very good job on that. But in terms of from a distress perspective, I think it's almost early days. What is the real risk that one is posing, what is being posed, and a very interesting conversation that we had yesterday. And Janina, I'm going to probably pass this question on to you, is in this whole concept of impact COVID-19, you've also got a lot of dynamics from a prescribed assets perspective. What are the likely changes to Regulation 28, and investors coming into an illiquid asset class? Would it actually be ticking the boxes for this potential prescribed assets category versus just being seen as an unlisted instrument, unlisted investment that the clients made, and they've got only so much capacity in the current regulation 28 to do this. And how do you think are investors first taking a wait and see approach to see what prescribed assets is really going to be telling them if it comes through? Does make hopefully my question makes sense. It's a big, broad question.
No, that's fine. And I could speak for hours about prescribed assets because obviously we've been living, breathing, and fighting against the concept for so long now. You know, I think the concept of prescribed assets in terms of ANC manifesto, particularly for last year's election, was always linked very much to developmental assets. And I think we all understand that South Africa is in a desperate situation. So we critically need to do whatever is necessary to motivate assets into investments that actually can create growth, create jobs, etc. I mean, I think there's 100% alignment. And if you look at the papers that have been coming out from Minister Mboweni, from Business for South Africa, the ANC, presentations last week at NEDLAC, everyone's talking about infrastructure, impact investing, and that this is the way to go. The only question is, how do you actually make it happen? And the issue for me is we've spoken quite a lot today about illiquidity, that you're going into unlisted investments, maybe 10 to 12-year terms, having gradual reevaluations and so on. The reality is that the South African retirement fund industry is mostly defined contribution. So most funds have not hit those Regulation 28 limits on alternative and unlisted assets anywhere close at all. So increasing the limits and saying now a lot of retirement funds are suddenly able to invest more into unlisted assets and help be the engine that actually drives the South African growth, it just isn't going to happen. So many funds just can't invest into liquids. Their trustee boards, investment committees don't have the bandwidth. It's just not feasible. So this isn't going to be the savior in terms of the infrastructure spend. Obviously, funds that want higher limits will be delighted if Regulation 28 is amended that way, and there will be some assets that then flow. But the reality is we really need creative financial solutions in the liquid space. Green bonds, bonds that are specific for certain developments, and some sort of financial engineering that says that funds can invest in liquid bonds, but that underlying investment then goes into the illiquid infrastructure spend, etc. So some of that would release a lot more money from retirement funds. But also critically, these are massive projects. I mean, the Government Infrastructure Office is looking at 2.1 trillion over the next decade. The only way you're going to fund that is not local retirement funds. They're just too small. You need big companies, big infrastructure funds internationally, sovereign wealth funds, international pension funds, etc. So that is really what President Ramaphosa's drive should focus on, is those international investors. And one of their specific criteria is always going to be how much local investments are there into those assets, and also is it an investor-friendly environment? And believe me, prescribed assets will make them run and pay and essentially go look for alternatives in other emerging markets. Every emerging market who's been hit by COVID-19 is desperately looking for infrastructure investment. So if there's other more investor-friendly environments that don't have something like prescription, we won't get those international investors. And that is critical, absolutely crucial to us being able to dig South Africa out of where it is now.
No, I think those are very sobering words, Janina, and I think it is about coming up with that financial engineering in terms of making something that's illiquid more liquid. I'm just watching the time, and because we're probably running out of time, just maybe closing comments, because I would love to talk to all three of you for quite some time still, but maybe just closing comments, maybe starting with Patrice in terms of everything that we spoke about today. I just think Patrice's mic is on mute. Sometimes.
Sorry. Sorry, I just wanted to say risk aversion is going to rule going forward, and protection of capital is going to be the most important factor when making investment decisions.
I think that's right. Fagmeedah, can I maybe hand over the mic to yourself?
Yeah, Rudigor, I think just for pension funds to really seriously look at the green bond opportunity, for me, that really looks like a low risk or relatively low risk, even though it's less liquid, but a low risk opportunity to make an investment in an area in South Africa where we have a pressing need in terms of energy demand, and it really will be enormous in terms of job creation as well as supporting the economic growth of the economy with power supply. Yeah.
No, I totally agree with that. And there's definitely one of our colleagues, Santuri, that's listening in that will really appreciate your thoughts because she's very passionate about green bonds. Janina, maybe just your closing comments.
Just for me, what's been stark for me in the last few months is just how precious investments are to the underlying members who rely on them. Obviously, for a lot of people, COVID-19 means they will lose their jobs, and a lot of them their only savings will be their retirement fund savings to get them through to their next job. So I think just to realize just how precious investments are and how important it is to use those investments wisely. We all want to find solutions where those investments are helping to create new jobs and help people to thrive into a brighter future. It certainly seems very dark sometimes in the middle of this epidemic. So the concept of impact investing and actually helping to rebuild our country, I just think it's very precious.
Yeah, I think to myself, I think the current time frame that we're living has really given for myself a lot more purpose in terms of this is the real reason that this is the real contribution that you can give to society. So I think it also really makes you realize that you've got a massive responsibility in terms of what you do, because it's not about some fund or whatever. It's actually about a member. That member is a person, and that person's got a family. But I really appreciate everybody's input and thoughts, and because as Janina says, this is a very serious time that we're living in, and we must really consider each day how do we make a difference. So really, in closing, I would really like to thank all the panelists for sharing their time. It's always much appreciated. It's always very good to talk to you. I was hoping that we can fight a little bit more today, but I think we actually agreed on quite a few things. And then maybe in closing, I really just want to thank the audience, our clients and our friends for all the long-term support that they've given Ashburton. We really appreciate it. And maybe then just in closing to say thank you very much. Have a good day and please stay safe.